So let's talk about a new and really potent force that might be reshaping the markets as we speak. We're talking about a risk factor you're definitely not going to find in any traditional economics textbook, but one that could be rewriting the entire rulebook for investing.
Okay, just let that quote sink in for a second. It perfectly sets the stage for this new kind of corporate risk. It paints a picture of a world where a single comment, a single tweet, can suddenly put literally billions of dollars of shareholder value on the line.
All right, so here's our game plan. We're going to start with the incident that kicked this whole idea off, then we'll unpack the core theory itself. After that, we'll see how it ripples out into the corporate world, and finally, we'll get into how investors might actually play this new game.
So what does this actually look like in the real world? Well, it all kicked off with a media controversy that quickly turned into a fascinating and kind of scary case study for a whole new kind of market risk. So you had all these heavy hitters involved. The whole thing revolved around threats from the Federal Communications Commission, the FCC, to review Disney/ABC's broadcast licenses. And these threats, allegedly, came straight from the top, at the behest of the White House, all because of some comments made by one late-night host.
And here's the crucial part. This wasn't just another culture war battle. No, the key insight here is that this was a financial event. It was seen as a warning shot fired across the bow of every publicly traded company in the country. This one incident was so significant that it led to two brand new concepts for understanding market risk today. So, let's break them down.
So what is this authoritarian risk premium? Well, let's be clear. This isn't about your usual business risks like competition or new regulations. This is the extra unpriced risk a company takes on just by potentially ending up on the wrong side of a powerful political figure.
And this leads to a pretty radical shift in what we expect from corporate leaders. All of a sudden, CEOs and their boards have this new duty: political risk management. They now have to manage political relationships with the same intensity they manage their supply chains or their balance sheets. It's a whole new part of the job.
So what happens when every company starts to think this way? Well, the impact goes way beyond just one company or one incident. It creates something of a chilling effect across the entire corporate landscape.
You see how this works? It's like a domino effect. This cascade is what's called a chilling effect. And the idea here is that the threat of political action is actually way more powerful than passing some new law. It creates this fog of uncertainty that forces companies and even their employees to start policing themselves just to avoid being the next target.
Okay, so if this is the new reality, the new playground, how do you invest in it? Well, the analysis lays out two pretty distinct strategies for navigating this very politically charged market.
The first strategy is basically to play both sides of the coin. On one side, you have what's called the FOT, or Friends of Trump portfolio. This is a bet on companies that are seen as politically connected and likely to benefit. On the other side, you've got the danger zone, companies with clear political liabilities or, say, strong ESG profiles like Disney or Meta, who could easily become targets. The investment thesis here isn't based on fundamentals. It's based entirely on political alignment.
And the second theme? Compliance costs. Honestly, the logic here is just brilliant. It's that classic saying, right? During a gold rush, sell shovels. The idea is to invest in the companies that are selling the tools to manage this new political risk. We're talking monitoring software, legal services, lobbying firms, the whole shebang.
So for our last section, let's zoom out, because this whole theory might just explain a really strange disconnect we're seeing in the wider economy right now, a world where the old market rules just might not apply anymore. On the one hand, you look at the S&P 500, and wow, it's hitting all-time highs. On the surface, you'd think everything is incredibly strong.
But then you peek under the hood at data like the leading economic indicators, the LEI, and they're flashing some serious warning signs. A negative reading like this, it suggests a manufacturing recession and some real consumer weakness could be just around the corner. And here it is, the unsettling conclusion that ties it all together. This massive disconnect could be the proof. The theory suggests the market isn't rallying because of strong fundamentals, it's rallying because it's playing by a completely new set of rules where political outcomes now matter more than the actual economic data.
And that brings us to the final, really provocative question. What does the future of investing even look like for all of us when the game itself seems to be fundamentally changing right under our feet?